If you want awesome products at great prices, check out the description. Great Britain's energy infrastructure is poised for a massive overhaul, a £24 billion investment set to reshape the nation's energy landscape. This ambitious undertaking, however, comes with a significant price tag for consumers. Ofgem, the energy regulator, has approved a staggering £15 billion for upgrades to gas transmission and distribution networks over the next 5 years, extending to 2031. Adding to this substantial sum is an additional £8.9 billion earmarked for a dramatic expansion of the high-voltage electricity network, the most significant upgrade since the 1960s. A further £1.3 billion is also slated for investment, bringing the total to a monumental £24 billion. This financial commitment will facilitate the completion of 80 large-scale energy infrastructure projects by 2030, a crucial step in the government's drive to bolster the UK's renewable energy sector and enhance its energy security. The ambitious plan aligns with the government's broader push for a greener energy future, aiming to reduce reliance on volatile gas prices and improve resilience to global energy market fluctuations. But this significant investment will inevitably impact household budgets. Ofgem's decision anticipates a £104 increase in annual household energy bills by 2031, a £30 rise attributed to gas network upgrades and a £74 increase linked to the electricity grid expansion. This translates to an additional £24 annually, further increasing the financial burden on consumers already grappling with elevated energy costs since the crisis that began in 2021. However, the regulator argues that this investment is necessary to avoid even higher costs in the long run. Without this upgrade, bills could rise by an additional £30, according to Ofgem. The rationale behind this assertion is that the investment will allow the UK to optimize its utilization of clean renewable energy, minimizing reliance on expensive gas-fired power plants. This strategic shift towards renewable sources aims to mitigate the country's vulnerability to global gas price volatility and strengthen its energy independence. This significant investment plan has already sparked debate, particularly concerning its implications for the Labour Party's ambitious goal of transitioning to a clean energy system by 2030, a transition that the party has previously claimed would ultimately lead to lower energy bills. The potential discrepancy between projected cost savings and the immediate increase in household bills presents a significant challenge for the Labour Party and its ambitious clean energy agenda. Jonathan Burley, Ofgem's chief executive, defended the decision, highlighting the crucial role of substantial investment in bolstering the energy network's resilience against the shocks of unpredictable global gas markets. He emphatically stated that inaction would prove far costlier for consumers in the long run, underscoring the critical nature of the project for national infrastructure. Burley also emphasized the importance of timely and efficient project completion to minimize the long-term cost to consumers. He reiterated Ofgem's commitment to cost control and securing a favorable agreement for both investors and consumers, asserting a willingness to intervene if network companies fail to meet their deadlines and budgetary targets. This reassurance comes as Ofgem's quarterly price cap recently reduced the average annual dual-fuel bill by 7%, bringing it down to £1,720. The regulator's draft verdict incorporates a proposal to increase the returns on equity investments in grid companies. A definitive decision is expected by the year's end. Ofgem's proposed cost of equity stands at 6% for private investment in grid companies, a notable increase from the previous 5 years' rate of 4.55%. Major energy utilities, including National Grid, SSEN Transmission, and Scottish Power, submitted their investment plans, seeking returns as high as 6.9%. SSE, a significant player in the energy sector, voiced concerns that Ofgem's proposed return rates are insufficient, failing to reflect global market competitiveness, robust market evidence, and the inherent risks associated with substantial investment in electricity transmission. Despite SSE's reservations, the market appears to have reacted positively to Ofgem's announcement. SSE's share price increased by 1.8%, National Grid saw a 2.2% rise, and Iberdrola, the Spanish owner of Scottish Power, experienced a 1.3% increase. This upward trend in share prices suggests that investors view Ofgem's decision favorably, anticipating the long-term benefits of the substantial investment in Britain's energy infrastructure. The £24 billion investment in Great Britain's energy networks marks a significant step towards modernising the nation's energy infrastructure and securing a more resilient and sustainable energy future. However, the immediate impact on household bills presents a clear challenge, raising concerns about the balance between long-term benefits and short-term financial burdens on consumers. The coming months will be crucial in assessing the true implications of this sweeping investment plan and its impact on the UK's energy landscape.